All right, let's dive into some truly impactful news. In the fast-paced world of technology, few companies ignite as much conversation and speculation as NVIDIA. Their latest earnings report just hit, giving us a front-row seat to, well, blockbuster numbers, some surprising market jitters, and a clear vision for the future of AI. Today, we're taking a deep dive into NVIDIA's Q2 fiscal 2026 results, the fascinating discussions that emerged from their earnings call on August 27, 2025, and what it all means for the company, the global AI landscape, and ultimately, for you.
What's truly compelling here is how NVIDIA navigated a remarkably complex quarter. I mean, they delivered record-breaking performance, yet had to contend with significant geopolitical headwinds and market expectations that were, quite frankly, sky high. We'll be connecting the dots between their impressive financials and the broader, accelerating AI race.
Exactly. Our mission today is to unpack all of this. We'll kick off with those headline numbers and the surprising initial stock reaction. Then we'll zero in on the core growth engines, data center and networking. We can't ignore the ever-present China question, which casts a long shadow, before looking ahead to NVIDIA's future with their Blackwell and Rubin platforms. And finally, we'll check in on other key segments like gaming and automotive just to see how the whole ecosystem is evolving.
Sounds good.
Sounds like a plan. Let's get into it. Okay, let's start with those core financial results for Q2 fiscal 2026, which wrapped up on July 27, 2025. NVIDIA reported revenue of $46.7 billion. Now, that's a solid 6% increase quarter over quarter and a massive 56% jump year over year, coming in slightly above the street's consensus of, what was it, $46.2 to $46.7 billion.
Right, a very strong top line.
And adjusted EPS, or earnings per share, hit $1.05. That's up 30% sequentially and 54% year over year, beating estimates of $1.01 to $1.02.
Another beat there.
Gross margin on a non-GAAP basis was 72.7%. That's down just 30 basis points year over year, so only 0.3%, but it's a significant leap quarter over quarter from 61.0%.
Interesting dynamic on the margins.
Yeah, and non-GAAP net income soared to $25.8 billion, a 52% increase year over year. And looking ahead, their Q3 FY26 revenue guidance is a robust $54.0 billion, plus or minus 2%, comfortably beating the $52.76 to $54.0 billion consensus. Non-GAAP gross margins expected around 73.5%. So all incredible numbers, right?
Absolute stellar across the board.
But here's where it gets really interesting, though. Despite all those beats and that strong guidance, NVIDIA's stock initially dropped 35% after hours. That's a head-scratcher, isn't it? What do you make of that initial market reaction, given the blockbuster performance?
Yeah, it certainly was a head-scratcher for many, and it really highlights the irrational expectations that now surround NVIDIA. The market wasn't reacting to poor performance, not at all. It was reacting to extremely elevated whisper number projections, those unofficial estimates that go beyond the official analyst consensus. So while NVIDIA beat the consensus, they slightly missed against those top-tier whisper numbers in data center revenue. They reported $41.1 billion versus very high expectations, maybe $41.2 to $41.3 billion.
Okay. So a tiny miss against a huge unofficial number.
Exactly. That, combined with the complexities around China sales, which, importantly, were explicitly excluded from their forward guidance, created enough friction to cause that initial dip. It really speaks to the extreme premium being placed on every single detail, especially when you consider the stock was already up, 51% in the 6 months leading into this report?
Right. Context is key there. And here's a truly shocking detail from that report. The company achieved this record-breaking $46.7 billion in quarterly revenue without shipping a single H20 chip to China.
That's incredible. Just think about that. Record revenue without that major market piece.
It really is. That incredible feat naturally begs the question, what is the engine powering this unprecedented growth?
Yeah.
Let's now zero in on the true powerhouse of NVIDIA's business.
That's the data center.
The core engine, definitely.
This segment remains absolutely dominant. It brought in $41.1 billion in Q2 FY26. That's up 5% sequentially, 56% year over year, and accounts for 88% of total sales. It's huge.
Just staggering numbers.
And a massive driver here is the Blackwell platform. This is NVIDIA's latest generation architecture, specifically engineered for the next leap in AI. Blackwell data center revenue grew a robust 17% sequentially. CEO Jensen Huang called Blackwell the AI platform the world has been waiting for, noting extraordinary demand. Blackwell Ultra production is ramping at full speed. He seems incredibly confident. Are there any, potential challenges on the production side or maybe competitive pressures we should be mindful of, even with this strong rep? Well, Jensen's optimism is certainly infectious, and the demand is undeniably voracious. But look, maintaining this relentless cadence and scaling production for something as complex as Blackwell, that will continue to be a significant logistical challenge. And while NVIDIA's lead is formidable, you always have smaller players innovating in niche areas so the competitive landscape stays dynamic. You can't get complacent. But if we connect this to the bigger picture, right, the continued robust growth in data center, even with that slight miss against those whisper numbers, it just demonstrates the foundational shift happening in computing infrastructure. It's not just about selling more chips anymore, it's about building entire AI factories. This is a fundamental re-architecture of how computing is done globally, and NVIDIA, well, they're providing the core building blocks.
That's a great point. And speaking of building blocks, many investors might still overlook this, but NVIDIA's networking business is rapidly becoming, almost $1 trillion subunit
Yeah.
within the company. It's exploding.
Yeah, it's often overshadowed, but critically important.
In Q2 FY26, networking revenue hit $7.25 billion. That's a staggering 46% increase quarter over quarter and nearly 98% year over year. It's pushing towards a $30 billion annual run rate.
Yeah, almost doubling year over year.
Key products driving this include Spectrum-X Ethernet solutions. Think of these as the super-fast specialized data highways within modern data centers, crucial for large AI clusters. Then you have InfiniBand and NVLink, which are more like direct, high-speed neural connections between the GPUs themselves, allowing them to act as one massive supercomputer. And the economic role of networking is pivotal. Choosing the right networking can lift effective cluster throughput from maybe 65% to 85–90%. That creates like $10–20 billion of effective benefit in a big $50 billion 1 gigawatt factory.
What's truly fascinating here, and perhaps overlooked, is that NVIDIA isn't just selling the brains of AI with their GPUs, they're selling the nervous system too, making sure those brains communicate at peak efficiency. This isn't just an add-on, it's a critical multiplier effect. Imagine buying a super fast car but then driving it on dirt roads. The networking is what paves that high-speed highway for AI, unlocking billions in value by maximizing the hardware you already have.
That's a perfect analogy. And beyond the traditional enterprise, NVIDIA is also tapping into an emerging, globally strategic opportunity. Sovereign AI. This isn't just about corporations anymore. It's about nations investing in their own AI future. So what exactly does this mean for national economies and for NVIDIA?
Yeah, this is a really interesting trend.
It's a rising opportunity where countries are developing their own AI using domestic infrastructure, data, and talent. It's having a significant financial impact, expected to reach over $20 billion in revenue this year for NVIDIA, more than double last year's figures. We're seeing global initiatives like the EU planning EUR, $20 billion for 20 AI factories, and the UK unveiling an NVIDIA-powered AI supercomputer.
It reflects this growing recognition of AI as a national imperative. It lets countries customize AI for their own language, their culture, their data, reducing reliance on the big cloud companies and fostering self-sufficiency. It's really a strategic move for national security, economic development, even cultural preservation, as these AI models become more ingrained in daily life.
Right. And then there's enterprise AI. Jensen Huang calls this the third pillar of growth, standing alongside cloud and sovereign AI. NVIDIA is launching RTX Pro servers for on-premise enterprise AI, and they're already working with most Fortune 100 companies. Examples abound. Amdocs using it for customer service. ServiceNow has now Assist. SAP building dual copilots. Cohesity with generative AI agents. Snowflake collaborating on copilots. Even Lilly is leveraging NVIDIA AI Omniverse, reportedly reducing factory cycle times by 50%. That's huge.
It's huge real-world impact already.
And their software strategy is also impressive. NVIDIA AI Foundry Service, which includes Meta's Llama 3.1, and NVIDIA NIMs, these are like pre-built AI models that accelerate deployment and show significant cost savings. AT&T, for instance, saw 70% cost savings with NIMs. This focus on software is critical, and it's expected to approach a $2 billion annual run rate exiting this year.
That software piece is going to be increasingly important for stickiness and value capture.
Absolutely. Now let's address the elephant in the room, the China question. What impact are U.S. export controls actually having?
Yeah, this is the big variable.
So in Q2 FY26, there were no H20 sales to China-based customers. Zero. NVIDIA did manage to release $180 million of previously reserved H20 inventory, selling it to an unrestricted customer outside of China. But CFO Colette Kress noted that NVIDIA was unable to ship $2.5 billion in China H20 GPUs last quarter. That implies maybe an $8 billion Q2 revenue hole just from these export restrictions.
An $8 billion hole. Wow. That really puts the scale of the restrictions into perspective.
And importantly, the Q3 FY26 outlook of $54.0 billion does not assume any H20 shipments to China.
Right, so that guidance is built without China H20 sales factored in. That introduces a significant layer of uncertainty, doesn't it? Analysts noted that different expectations regarding China revenue created what they called a messy quarter, and it very likely contributed to the stock's initial dip despite the overall strong results. It just underscores how difficult forecasting becomes when geopolitical factors are so volatile and can shift really quickly.
Makes sense. Despite these restrictions, though, CEO Jensen Huang still sees significant long-term potential in China. He estimates China represents a roughly $50 billion opportunity this year if NVIDIA can serve it competitively, with potential for around 50% year-over-year growth.
So the opportunity is still massive, if accessible.
Exactly. He also stated that bringing Blackwell to China is a real possibility, but subject to U.S. policy, of course. And if geopolitical issues were to somehow subside, NVIDIA could potentially ship maybe $25 billion in H20 revenue to China in Q3 alone. That's a lot of potential upside.
The caution on China is certainly warranted, but the truly remarkable performance everywhere else means that, for now, China is effectively a bonus, like you said, not a necessity for NVIDIA's current growth trajectory. It's also worth noting that in the interim, this situation, well, it presents a strategic gain for Asian chipmakers like Huawei and SK Hynix who are stepping into that market gap.
Good point. So with such phenomenal growth and this critical strategic importance, what's next on NVIDIA's roadmap? Let's turn our attention to that relentless innovation machine. The roadmap is key. NVIDIA is clearly on an annual cadence now, trying to keep lifting performance per watt. Blackwell production ramp is scheduled to begin in Q4 FY26, with several $1 billion in Blackwell revenue expected just in that quarter. Interestingly, Hopper, their current generation, H100, H200, still sees strong demand. It's expected to increase in the second half of calendar 2024, coexisting with Blackwell as Hopper supply has improved. So both platforms running strong side by side for a while. Seems like it. And looking even further ahead, the successor to Blackwell, codenamed Rubin, is apparently on schedule for volume production next year. That means 2026, and already consists of 6 new chips in fabrication. 6. Rubin is expected to bring a lot of great ideas to be detailed at a future GTC conference. You almost wonder if Jensen Huang ever sleeps, given how quickly they're iterating.
It's an almost dizzying pace of innovation, truly. And it begs the question, why? What's driving this relentless push? Jensen Huang emphasizes that we're experiencing 2 simultaneous fundamental platform transitions. The first is from general-purpose computing to accelerated computing. That dramatically drives down cost, energy consumption, and enables much larger scale. The second transition is from human-engineered software to generative AI, a completely new way of creating and interacting with software. This, he argues, is the core reason for the AI race we're witnessing. It's like we're not just upgrading a car, we're suddenly flying spaceships and learning to navigate entirely new galaxies all at once.
That's a powerful way to put it. But this relentless investment in AI factories is immense. Some investors are surely asking, is this a sustainable boom? Are we heading for an AI bubble? What's the tangible return on all this CapEx?
That's the million-dollar question, isn't it? And Jensen Huang offers a multifaceted answer that directly addresses that skepticism. The core insight is that these AI factories aren't just speculative bets. They're delivering tangible, sort of triple thread value right now. First, there are massive cost savings through accelerated computing. He cites examples like 90% computing cost savings, 50x speedups in data processing, recommender systems.
Real savings.
Real savings. Second, there's guaranteed revenue from AI startups consuming tens of billions of dollars yearly from cloud service provider, CSPs. That ensures high utilization of this new capacity almost immediately. And third, generative AI offers rapid return on investment, ROI, for internal services. Things like next-gen ads, recommenders, search systems, enhancing productivity for enterprises. He's not just talking theory. We're seeing these returns in practice. It's fueling this projected $3-4 trillion global AI factory build-out by the end of the decade, with hyperscaler CapEx already around $600 billion per year and still rising.
Okay, that makes a strong case for the ROI. But with such immense expansion, are there any looming bottlenecks on the horizon, like power constraints or liquid cooling infrastructure? Could that slow things down?
It's a valid concern. Jensen's take is that NVIDIA is proactively addressing these. They offer multiple Blackwell configurations, including both traditional air-cooled HGX and newer liquid-cooled Grace Blackwell systems. Now, while liquid cooling requires new infrastructure, it's actually cheaper in terms of total cost of ownership, or TCO, and crucially, it allows 3 to 5 times more AI throughput in power-limited data
Oh,
centers.
interesting. Cheaper and more powerful in constrained environments.
Exactly. This enables those massive NVLink domains of 144 GPUs in the GB200 NVL72 systems, which is vital for low latency, high throughput LLM inference. So it's a strategic move to unlock even greater compute density where power is the bottleneck.
Got it. Okay, beyond the massive data center story, let's take a quick look at NVIDIA's other segments. They continue to show impressive growth too. Gaming revenue was $4.3 billion, up 14% quarter over quarter and 49% year over year. The new Blackwell-powered GeForce RTX 5060 is already NVIDIA's fastest ramping by 60-class GPU ever.
Wow, fastest ever for that class.
Yeah. Their DLSS 4 technology, using AI for upscaling and frame generation, is now in over 175 games. And importantly, RTX PCs are now really being positioned as AI PCs, powerful personal computers capable of running sophisticated AI apps locally. There are like 600 AI-powered applications taking advantage of this already.
Bringing AI capabilities down to the consumer level.
Exactly. And in automotive and robotics, revenue hit $586 million, up 3% sequentially to a strong 69% year over year. Their Drive AV software platform for autonomous vehicles is in full production. Initial shipments of Drive AGX Thor are underway, and the Jetson AGX Thor developer kit is available for robotics development. Plus, they have things like the Halo safety platform and Cosmos World Foundation models for simulation.
So while data center clearly dominates the revenue pie, these other segments demonstrate strong, diversified growth. They really highlight NVIDIA's ability to leverage its core AI and computing expertise into much broader markets. It's effectively fueling what they call the age of physical AI in areas like self-driving cars and advanced robotics. It really ensures a robust ecosystem beyond just the cloud data center.
Good perspective. Finally, let's just check in on NVIDIA's overall financial health and their commitment to shareholder returns.
Yeah.
The company boasts an impressive $56.8 billion in cash, cash equivalents, and marketable securities. That's up 63% year over year.
A huge cash pad.
Huge. Free cash flow stood at a healthy $13.5 billion for the quarter. They also approved an additional $60 billion share repurchase authorization, adding to the $14.7 billion remaining from previous ones. In the first half of fiscal 2026 alone, NVIDIA returned $24.3 billion to shareholders through buybacks and dividends.
Those numbers just underscore a company in an exceptionally strong financial position. They have ample liquidity and a clear, aggressive commitment to returning value to shareholders, even while making these massive investments in future growth. It shows tremendous financial flexibility and, frankly, confidence in their long-term trajectory.
So wrapping this up, what does this all mean for us? NVIDIA's Q2 FY26 earnings. They paint a picture of relentless innovation and overwhelming, almost insatiable demand. And this holds true despite those geopolitical hurdles and the sky-high market expectations we talked about. From the astounding growth in data center and networking to the promising futures of sovereign and enterprise AI, the company is undeniably at the heart of a fundamental global computing transformation.
Yeah, the AI race is on, as Jensen Huang keeps saying. But beyond the impressive financials and the groundbreaking technology, this deep dive reveals maybe a deeper question for all of us to think about. As these AI factories scale into multi-gigawatt superfactories with such unprecedented concentrations of compute power globally, what unexpected challenges or maybe societal shifts might arise from this level of centralized technological capability?
That is definitely something to chew on until our next deep dive. Thank you for joining us.